What's good, everyone? It's your boy Liquid State back with another video. This time we're going to be looking at liquidity, kind of talking about how it functions across markets, why it's there, what its job is, how markets move in accordance to liquidity, and all of that kind of jazz. So yeah, let's get into it. So effectively, when we actually talk about what liquidity is, it's what it comes down to is the ease of which an asset can be bought or sold, kind of how much of the asset is available to be traded at a specific time. The way that this kind of relates to how we trade is like, if you're opening a buy position, there needs to be a willing seller to enter the market at the same time for you to buy from. So like if you're buying something, obviously someone has to sell it to you, right? It's the same with when we trade Forex, indices, crypto, whatever you're looking at. Like you need to have a willing opposing market participant to take the other side of your trade for it to be filled, right? So it's kind of like, yeah, the essence of supply and demand is like, if you have too much supply and there's not enough demand, then there's not going to be any willing buyers to actually take price higher. So that's what we see, like down here, there was way too much demand and the supply was just like minimal, effectively. So the demand pushed price all the way up to here, which is what we saw. Oh yeah, this is this is soybean futures, by the way. I just thought I'd open up a random chart. I've like never looked at soybean before, but it's kind of, we can look at it and kind of see how liquidity works, because it functions relatively similarly across like any asset, anything that can be bought and sold and traded. Yeah, there's liquidity. Like you can think about this, I don't know, this is probably some weird analogy, but when we traded, chickens for mortar, I don't know if that would be around at the same time, but if we're trading like chickens for mortar, for example, you need someone to sell you the chickens, right? If you're buying, if you're selling your mortar and you're buying chickens, you need someone to sell you the chickens. So yeah, that's effectively what we're looking at in any financial asset, just the ability to buy or sell something to another willing participant. So the way in which markets move is, if you saw my last video, you'll know that the direction in which they move is dictated by structure, but effectively the essence of how they move, they're always like, any price is always going to be gravitated to liquidity. Like price will go to a point in which there will be transactional kind of medium for there to be lots of transactions to take place, right? So basically what we can see along this chart is price is still following structure, but there's lots of liquidity intricacies in between the structural kind of flow of things. So if we have a look from the start of basically when this was recorded, 1970, we had one big push to the upside, right? So basically since this is the start of our price data, this is all we're going to go off. So we're effectively expecting a new lower high, higher low in the market before we break this high right here. And as we can see, this is the lowest point right here before price breaks to the upside. Yet again, what are we expecting? Well, a higher low before a higher high. And as we can see, we get it quite a lot quicker this time. That only took like less than a year to actually make this higher low before we break up again. And now what are we expecting? Well, the exact same thing, a higher low before a higher high. And we haven't quite broken this high yet. We are still within the trading range of it. But yeah, that's what we're essentially expecting to happen, because we don't expect a new structure. We should never expect new structure. But anyway, how this pertains to liquidity is quite interesting. So as I said before, price will be drawn to liquidity points. So the easiest way to define and identify liquidity points is through highs and lows of price. So if we just look at, well, we'll start over here. We come down, we make this low, and then we come up and make this high. This high is made because price traveled from this low, we go above the high to effectively create enough liquidity within a market to allow for orders to be placed. And as we can see, when we took this high out, there were willing sellers and buyers, depending on how they're viewing, depending on what their bias is. You know, some might say if this high goes, then I'm expecting price to just keep going, or like they're expecting maybe we come up to the high and then push down. So there's going to be, you know, quite a lot of transactional value at this high. And of course, this is on the monthly time frame as well. So this is a monthly high, which is, of course, very kind of important. So yeah, we come up and take the high, and as you can see, after we take this high, we just have a huge kind of push to the downside. Now, you'll see it doesn't always take every low and high, because otherwise there would be no structure. That's an important thing. Like, it's not, price isn't going to go and take every major high and low in a market, because otherwise it would basically look like this. And that would just be completely pointless. That there's no like transactional value here. Yeah, instead we basically see, to follow structure, because we're expecting a new high, as I mentioned, we will see kind of smaller internal lows or highs, depending on which direction you're going in. We'll see them get taken instead, to facilitate effectively that next move. So like in this case, we can see this little, well, it's not that little because it's the monthly time frame, but we can see this low gets taken as liquidity, and then price moves to the upside again. Again, we can keep seeing this internally as well as this bigger structural push, but like we have these internal structures, we still have lows and highs that get made, we sweep them and effectively tap into a pool of orders, willing buyers and sellers, market participants, you can call it whatever you want, and that facilitates the next move higher, because we now have enough liquidity in the market to allow people to place orders, right? As we can see, another very aggressive move to the upside after we take this low. Again, this one doesn't take this high, but of course it takes this high and we start moving down again. So yeah, you can kind of see this all throughout. And if we just go to quite a key area, which is our higher low in the market. So as I mentioned before, we're going low, high, higher low, higher high. And if we just have a look at this higher low, what do we notice it does? Well, this is basically, this low gets retained all the way throughout this price until, like, you know, this is 8,500 days, which is about 23 years or so, which this low is retained. Like, nothing goes below this. Yes, we still have liquidity sweeps in between, like this, that gets swept here, etc., etc. But the main move up that like breaks the high, this weak high over here, was caused by effectively the biggest liquidity sweep within this whole amount of price action. And as I said before, I haven't actually looked at this price before. This is the first time I've seen it. But yeah, we can see that price takes effectively the biggest low within this entire range. So let me draw it on. The biggest low effectively, which is down here, or the lowest low really, that it retains, we tap it here, there's equal lows if you want to look at that. And yeah, they get swept aggressively, and that is where the rest of the move comes from. That's where we break structure. We got a big high to the upside, which again sweeps liquidity above this very important high right here. That causes the next move down. What happens? Well, yeah, we literally just tap below this low, 2005, and then we had the rest of the move up. So it's kind of, this is why it's important to look at structure first, because price will still be effectively dictated to by structure, but the formative kind of element of price action, or what price gets attracted to or magnetized to, is liquidity. And yeah, we can see we come up, take this high, well, we take this high, make this high, and then we don't get a really big sweep for this next one. We can see that we basically just take out this kind of smaller low right here, instead of maybe, you know, one of these, which is quite a lot bigger down here, or this one. But yeah, still, we tap into a big pool of orders underneath here, and that's what moves price. So yeah, it's the same kind of thing throughout. Like you can see again, what does this? Yeah, this where our next higher low is, sweeps this low right here. So still retains within our structure. This is our structural low. Price gets retained within it. Just sweeps this low, and basically all of these equal lows that are created afterwards down here before moving to the upside. And yes, you can look at like structural liquidity and buying ranges and all that kind of stuff. That I'll probably go into specifics and intricacies of that in another video. This was kind of more just meant to be like a holistic understanding of liquidity, what it is, why it's in markets, how price moves in accordance with it, and how structure still plays the biggest role in showing you where price is going to go. But yeah, like if we just quickly look at this bit here, effectively price pushes down into this low where people will be buying because it's a structural low, and then we come down and we actually break this high right here. So we now have this big buying range. Again, yeah, we break structure, which causes people are going to want to get involved down here to get along, and of course this whole buying range gets swept to continue price to the upside. Yeah, so this is really the start of another video here, but yeah, that was kind of a generalized overview of what liquidity is, how it forms, how it's used. Yeah, pretty much. Well, as you can see, we're on a completely different chart. I had to come back and finish the video due to unforeseen reasons, but yeah, I'm back now, just doing an outro. Basically, I got all the stuff covered that I want to in the video, but I didn't get the time to do an outro. So yeah, enjoy this little slideshow of German 40 trades. And yeah, I just wanted to finish up basically by saying this whole liquidity video is just a start. It's just an insight to how I use it, how it can be seen in the market, and just basically how the market moves in accordance to it. There's not too many like liquidity specifics within this video. That's going to be completely covered in future videos, don't you worry. We're going to have plenty of inducement, early sellers ranges, all of that kind of nice trap stuff, and yeah, lots of content coming for liquidity in the future. Just wanted to give this one as a brief overview. So yeah, I hope this kind of made some sense. I hope this cleared up some doubts and kind of allowed you to understand why markets move in the way that they do, why price seeks specific areas on specific timeframes at specific moments. Everything happens for a reason, realistically, in markets. Literally, it's all down to supply and demand and liquidity. Those are the effective fundamentals of pretty much everything. So yeah, do with this what you will. Obviously it's not too much right now, but we will go over very specific stuff in the future, so stay tuned for that. And yeah, have a good rest of your day, guys. And I forgot to say like, comment and subscribe. So as you can see, I'm in the edit booth, and just want to say, if you got any amount of little value, there's gonna be so much more coming. So hit that subscribe button, comment down below what you thought, what you'd like me to do next, and hit that motherfucking like button, homies, and have a great day. Speak to you all soon. Bye.